7 steps to consistently making 30 to 40% annual returns. From the Education Archives at www.philstockworld.com. Just a couple of decades ago, it would have been almost unfathomable for the retail investor to consider generating consistent returns above 20% per year. Indeed, gains in the stock market for Joe Public were subject to a limiting factor: the inability to leverage substantially. Joe Public was also limited in participating in private equity investments. They were the domain for the rich, the insiders. These days, private equity still remains the domain of the rich, but leveraging is possible through the purchase of equity derivatives, and the sale of those same equity derivatives can be highly profitable too. Whereas it would have been unthinkable years ago to consider making big profits year in and year out on a stock that doesn't move much, because the only source of income, dividends, tend to be in the low single digits in percentage terms. These days, options afford us the opportunity to sit tight and profit while holding stock positions. This can easily be achieved through the sale of short call options against stock holdings, otherwise known as the covered call strategy. While the covered call strategy may appear straightforward when first encountered, many applications may be employed. In this article, we'll consider our 7 steps to 40% per year. Step 1. Wait for a sell-off. Okay, so you want to skip this step and move to step 2. Wait. One of the great quotes in investing comes from Jesse Livermore and pertains to this concept of patience. Step 2. Check the fundamentals. Because the covered call strategy comprises stock ownership, we should know that it's close to a level that value investors will jump in, even if the stock drops lower in the short term. Some simple metrics to look out for include zero debt. In higher interest rate environments, debt-laden companies obviously suffer much more than those with no debt. Lots of cash. If you want to see an example of a company with lots of cash relative to its market capitalization, just check out Options Express. With so much cash on hand, there is an automatic lower limit on how low the stock can go. PEG 0.65 to 1.0. A low PEG, anything less than 1.0, indicates a company's multiple is low relative to its earnings growth. Return on equity 15%. A return on equity of 15% or more indicates the company is compounding value at a very attractive pace. Even if a stock isn't matching the return on equity figure in the short term, the likelihood is it will play catch-up in the future. A story. Companies with a story are always attractive to Wall Street analysts. Whether it's the iPod, global search, oil, consumer staples, etc., companies in different sectors will come into vogue at different times, and your job is to know what's in vogue now. You can be stubborn and stick with a sector that isn't moving much, but why remain so inflexible when another sector may be flying to the moon? Step 3. Check the technicals. Has the stock been beaten down? If so, it's time to pay special attention to the turn. Wait for the bottom to form and the stock to take off. Chances are, if step 2 is executed properly, the stock that is fundamentally strong will blast off like a rocket ship when sentiment changes in the market. Make sure to be alert to the shift. You'll know when it happens, because suddenly everybody will be racing to buy as much as they can, and greed will kick in. Step 4. Note the earnings. As mentioned, many covered call strategies exist, but the one discussed in this article pertains especially to taking advantage of earnings. You can easily spot when earnings take place by navigating to the Investor Relations Department link on the website of the company under investigation, or indeed by simply navigating to www.earnings.com. Step 5. Track implied volatility. By keeping a close eye on implied volatility, you will always know when options are expensive or cheap on a relative basis. In short, when implied volatility is high, as is usually the case right before earnings, options are very expensive. And when implied volatility is low, as is usually the case 1 to 6 weeks after earnings, options tend to be cheap on a relative basis. Once the implied volatility starts to pick up, it's time to start thinking about selling some expensive call options against the stock position you already own. From steps 2 and 3, you should have ended up with a solid stock after it started to trend bullish. Obviously, at the start of a bull run, there is little reason to cap gains with short calls. But if a bull run has occurred and implied volatility is high because earnings is approaching, why risk all those gains? In fact, why not sell some expensive call options to lock in some of the gains? And that's where step 6 comes in. Step 6. Sell 2 to 3 month short call options at the money. Options at the money tend to have greatest premium compared to options in the money or out of the money. Moreover, options with 2 to 3 months of time value can offer a nice compromise between choosing shorter term and longer term options. Shorter term options tend not to have nearly as much premium, obviously, as longer term options, but longer term options require that the covered call trader stick with a position for a long time. And while patience is key to successful long-term gains, it's also important that you're not so bored with your positions that you lose interest in the game altogether. Consider an example. ABX at $19.15 offers an attractive entry point, and with earnings coming up in November and the short October calls that strike $19, right on the money offer $1.30 of premium at $1.45. With expiration just 45 days away, the return on risk may be calculated as follows: $1.30 divided by $17.70 of risk. Even if the stock should stay flat, you already collected $1.45 against your $19.15 purchase. That equates to a return of 7.3% in 1.5 months. And if the stock should stay over $19 into the November expiration, which only requires it to flatline, the covered call position would gain 7.3%. That is the outcome of purchasing the stock and entering the short call simultaneously. Obviously, by using some technical analysis to assist in timing the stock entry on the bullish turn and entering the short calls closer to earnings, the result could be improved. Step 7. Wash, rinse, and repeat. Now all that is necessary to produce gains of 58% plus per annum is to repeat each 8 more times a year, even if you assume a few misses. At this rate, using this simple strategy in a flat to up market, you can make 40% a year. What would 40% per annum mean? On $25,000 of starting capital, 40% per annum for 5 years turns into $134,000 plus. Is that good? Perhaps. It's the next 5 years when the money really starts to mushroom. Another 5 years, it turns into over $700,000. Obviously, taxes impact gains in non-qualified accounts, but retirement accounts can be perfect for this type of strategy. Slow and steady wins the race. Remember, patience is the key. At Phil's Stock World, we have regular list of stocks that are on sale, and even on our closed buy list, there were still plenty of stocks we are willing to stick with, and we discuss them daily in our member chat room. Remember, your stock may not always go up, but using this strategy to make sure you make about 3% a month in premium sales ensures that you will beat the stock's regular performance by 40% per year. Doesn't that seem like a sensible goal to enhance long-term performance? Find out more by joining our members at www.philstockworld.com.